3 income closed-end funds I'm buying right now. Let's check them out. First, I'm going to start with RQI. That's the Cohen and Steers Quality Income Realty Fund. Ticker symbol RQI. Now, a lot of you guys know closed-end funds. I'm going to speak real quickly over it, do an overview of them, how they work. Closed-end funds are different than ETFs, okay? Their net asset value and the share price trade separately, okay? So it's the share price is determined by the individual investor, okay? Supply and demand, fear, greed, all that stuff. So it's really based upon what you're willing to pay, what I'm willing to buy, all that stuff. Has nothing to do with the actual value of what the fund is holding in its portfolio. Okay, so that can present some opportunity there, right? For instance, if something is, if the fund's assets all together are worth, 20 bucks a share, right? And investor B says, I'm willing to sell it for 15. I need out of this thing. You're essentially buying $20 worth of assets for $15. Now, funds can trade perpetually at discounts, and they can also trade perpetually at premiums as well. So you have to really pay attention. But the 3 that I'm looking at today, we're going to start with the RQI. And we'll see at the date of this recording, it is selling for $13.62 a share. The net asset value is $14.39. That represents a discount of 5.35%. So you're buying $14.39 worth of assets, net asset value, for $13.62. Now this fund overall, we'll look at the past 5 years. The net asset value, which is the blue line, the light blue line, has risen. Of course, it's fallen here in 2022. And the price you can see is in the dark blue, is normally what I was talking about, disconnected, right? There's times where you can buy it at a discount, right? You see here in December of 18, there was a wide discount. And then there's other times like right here where it's at a little bit of a premium. So these are times, if you were wanting to like buy and sell, you would buy at a discount and sell at the premium. Or you just hold on, reinvest at these downturns or buy more at these downturns and, pick up more shares. Right now, the price, the share price is falling faster than the net asset value. So that could present an opportunity if you are bullish on real estate, which I am. This one in particular pays a 7% distribution rate, 8 cents per month. We'll look at the fund basics here. This one's been around since February 2002, and interestingly enough, it has beat the S&P 500 over that time period with distributions reinvested. It does include leverage, so there's 26% leverage here. Leverage just means that they're using essentially borrowed money. It could be preferred shares that they issue. It's essentially debt, right, that they're using to boost the portfolio a little bit, okay? So at times like this, when things are selling cheaper, they may issue some shares or take out a loan and actually buy more assets. So what that ends up doing, though, is because these are actively managed funds and they use leverage, that means their expense ratio is going to be much, much higher than a normal passive ETF that really doesn't do anything, right? So total management fees, 1.1%. Interest expense is 0.63, so just under 2% in expense ratio. We look at the distributions here, a little bit choppy, especially coming out of the '08 recession. They had to cut a little bit, and then pretty much since 2000, they raised since then, and pretty much since 2000 and say, what is that, 15, they've paid pretty much 8 cents a month since then. Now, what are they invested in? They're typically invested in some of the best real estate out there. American Tower is 9% of the fund. This is going to be, I believe, some fixed income, public storage, Prologis, Duke Realty, Welltower, Invitation Homes. So you'll see you have stock, preferred stock, some bonds, some convertible stocks, so things of that nature. But mostly going to be in real estate. They do have 183 holdings, turn over their portfolio 38% for the year. So real quick, let's take a look and see how they performed over the SPY. So if we go all the way back, right, we'll look at this right here. If you reinvest the dividends from back in 2002, RQI returned 9.14%, where the SPY returned 8.37. So pretty interesting that it's very rare to find a closed-end fund that actually beats the SPY, to be honest with you. There's not very many out there. Next up, EOS. This is the Eaton Vance Enhanced Equity Income Fund. This is a covered call fund, okay? And this is in the tech sector. Now, I am of the opinion, I'm not a financial advisor, but I am of the opinion that tech is oversold at this point. Okay, with the NASDAQ down, I think it's 25% year to date. I think people are going to start piling in. I know there's interest rate talk and all that stuff, but I just think it's overdone. And this one gives you a little bit of an opportunity, not much of a discount here though. $17.08 share price. The NAV is $17.12. So you're pretty much buying it for what it is. If we look at a 5-year chart on the NAV to price, this one has tracked very tightly to its net asset value. Very rarely given you an opportunity for a discount. This one does pay 9.65% distribution rate, 13.73 cents a month. This one does 80% of its assets in common stocks, which they do covered calls on. Not the entire portfolio. It's actively managed. So, if they have, 10,000 shares of Apple, they may do half the position in a covered call and keep the other half just in case Apple runs, that type of thing. They also could possibly do some hedging to put some downside protection. But being a closed-end fund, they're not as transparent as an ETF. They don't need to be. They just need to have, they have certain filings, I think quarterly, that you can see their holdings. This one uses no leverage, which is nice. This one's been in inception since 2005, so we can have that backward look on performance. Management fee, 1% basically as a expense ratio. Distributions choppy here a little bit. Cut it coming out of the recession, but since 2011-12, they've kind of just paid 8.75 cents per month. And then in 2019 or so, they raised it. And then in 2021, they raised it to its current level. So what are its portfolio? It's going to be the big tech dogs: Amazon, Alphabet, Microsoft, Apple, Visa, Adobe, AbbVie, Qualcomm, Intuit, United Health. So very, big names that they're selling covered calls on. Small portfolio, only 60 holdings, and only turning over that portfolio 18%. Let's look at how they did against the SPY. They actually didn't do horribly bad. If we look at it with dividends reinvested, since 2009, why did I do 2009? Let's go as far back as we can go. So since 2005, the SPY returned 9.23% with dividends reinvested, and EOS returned 8%. So very decent. And I think right now with tech being oversold, if you want to have a 10% yield and possibly participate in a tech recovery, I think EOS might be one to look at. Now, last but not least is going to be controversial a little bit, but it's PDO. That is the Pimco Dynamic Income Opportunities Fund. It's a bond fund. Now, people are going to say, bonds, ill. Yeah, I kind of agree. But Pimco is the number one investor in bonds in the world, basically. And what we have is a pretty new fund. This came out in January 2021. We look at the NAV, it's just gone down because the bond market hasn't done very well, especially some of the bonds that they're investing in. But what you'll notice here is typically Pimco funds trade at a premium, right? Ever since inception, this thing traded at a big premium, the darker blue line. And it wasn't until December 21 or so that people got bearish and started selling out and selling for less than it's worth. So right now you can pick up PDO at $15.03. The NAV is currently sitting at $16.65 for an almost 10% discount to net asset value. It does have a distribution rate of 9.45%, paying you 11.84 cents per month. Now, I'm not going to lie and say I'm an expert at bonds because I'm a total idiot when it comes to bonds, but basically they buy bonds opportunistically. Okay, Pimco, if you look at I'm not going to go through it, but this thing has so many holdings, it's unreal. And Pimco has, access to all kinds of bonds and fixed income globally. So right now, and also Pimco uses leverage like crazy. So this is 47% leveraged at the moment. And expense ratio, they don't have it listed here on CEF Connect, but it's over 2%. That's a lot of it is due to the expense of the leverage. You look at the distributions, 11.84 cents per month. They did pay a big cap gain of 60 cents back in December. I kind of don't expect that this year. And if you look at the portfolio holdings, U.S. Treasury bills, IRS USD, there's probably like income swaps and things like that, Centiverse holdings. You're probably not going to know very much of it. 471 holdings. And then what I like about it is the maturity. Half of their portfolio, 14.76 and 34. So that's almost 50% of their portfolio has a maturity of 1 to 5 years. What that means is they can, as these bonds mature, they can get into things, they can get some of these lower paying bonds out of the portfolio and get into some of these higher income yielding bonds. So I have full confidence in Pimco being able to navigate that and making sure that the income generation is there. So that is PDO. So that's all three I got for you guys. RQI for real estate, EOS for technology, PDO for fixed income, all giving you about a 7 to 10% dividend yield paid monthly, mostly all trading at a discount. I like them. Not sure if they're for you or not. That's up for you to decide. Hope you enjoyed this content. Join me tomorrow for the live stream. Last week we set a record for thumbs down on the live stream. So I'm just going to tell you right now, if you're sensitive, it's not all about stocks and options. Sometimes we talk about stocks and options. Sometimes we talk about abortion. Okay. But I'm going to just leave it all out there. And a lot of times that will get me unsubscribers and dislikes, and I do not mind. So hope you guys enjoyed. Leave me a comment down below. Like, share, subscribe. Talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.